Okay, hello everyone. Hope you're all well. And thank you very much for joining today, and welcome to our webinar ahead of next month's US presidential election, its potential impact on the foreign exchange market. Brief introductions before we get going. So my name is Matthew Ryan. I'm Senior Market Analyst here at Ebury, based in our London office in the UK, although, as you can probably tell, given the unfortunate situation surrounding COVID, currently working from home at the moment. We also have on the call our Chief Risk Officer and Bloomberg forecaster, Enrique Diaz-Alvarez, who will be presenting as well today, and he's joining in from New York. So I think we're all good to get going. I think we'll start and get straight into it. And we're going to, as I said, focus on November's US presidential election. I'll start by giving a brief structure to the sort of overview as to how we're going to structure this webinar. So I'll start off by giving a sort of a state of play as the latest opinion polls, who is ahead in the polls, what the latest implied probabilities are saying regarding the election. We'll then talk a little bit about the voting system in the US, how the voting system works, the so-called Electoral College voting system. Talk a little bit about the key swing states, which states to look out for on election night, and how each candidate is performing in each of those states. I'll then hand over to Enrique. I'll talk a little bit more about how the market has reacted leading up to the election, specifically the FX market, and then what we expect after the vote. With a special focus on the US dollar, of course, but also emerging markets with a focus on CNY and our outlook for both the euro and the pound. And that should take around about half an hour, 40 minutes or so for the core section of the webinar. We'll then have time for Q&A at the end. So there is a Q&A button, a little section in the Zoom app. So if you do have any questions as we go through the presentation, please feel free to type in the questions in that Q&A section, and then we'll be able to get around to answering those at the end of the webinar. So I think with that out of the way, I think we'll crack on and get going, talk about the latest opinion polls to start with, ahead of the election, which will take place on Tuesday, the 3rd of November. So a little under 2 weeks to go until polling day, in what we think is going to be probably the biggest event risk in the FX market between now and the end of 2020. Now, Democrat Joe Biden, as you can see from the chart, currently holds a very comfortable advantage in the latest opinion polls, around about 8 points at the moment, 51% to 43%. We have seen a slight narrowing in the polls in the last few days. Although if we look at the situation compared to before the pandemic in around February time, Biden's lead has grown since then from around about 4 points to 8 points today. Now, campaigning has really picked up pace in the US, particularly since the first televised debate between the two candidates at the end of September. And support for Trump has actually fallen fairly markedly since then. There was a general air of expectation that Trump would use the platform to narrow the gap in the polls, as has often been the case during first debates in past elections. But his relatively poor performance in the debate has led to a narrowing of the polls, as I said. And then, of course, we had Trump's positive COVID test in early October, his subsequent hospitalization and quarantine period, which has damaged his chances of election even more. And the polls have widened further, and as I said, around about 8 point advantage for Joe Biden, which is a fairly commanding lead as things stand. Now, probably one of the main big questions going into this election is, will the polls actually be accurate this time relative to 4 years ago, where they were proved to be incorrect? Investors are actually fairly confident that this time around will be slightly different from 4 years ago. I think if we cast our mind back to 2016, Hillary Clinton, of course, had a fairly comfortable lead in the polls in the months leading up to polling day, only to lose the race to the White House unexpectedly on election day. We actually think that this time around will be slightly different, and there are two reasons why we think that. The first of which, I think, if you look at the graph on the right-hand side, you can see that Joe Biden's lead over Donald Trump has been consistently larger than Hillary Clinton's lead was over Trump in 2016. So that darker blue line, that represents Biden's lead over Trump in 2020. The lighter blue line, that represents Clinton's lead over Trump in 2016 over the same time period leading up to the vote. As you can see, from around about sort of early to mid-May time to the present, Biden's lead has been consistently larger than Clinton's. And if you were to actually average out Biden's lead during that time, it would be considerably larger than Clinton's lead over that same period. And actually, Clinton's lead fell to less than 2% in the few days leading up to the vote, in part due to the email scandal that marred the end of her campaign. The second reason why we think that this time will be slightly different is that we think the pollsters have actually learned their lessons from last time. If we look at the surveys in 2016, the national polls were actually relatively accurate at the national level. Hillary Clinton did actually win the popular vote. She obtained more votes than Donald Trump on election night, only to lose the election due to the Electoral College system, which we'll talk about in a few slides' time. So it really was an issue with the state level polls, and we think that the pollsters have changed their methodology sufficiently so that the risk of mistake this time is much less than it was in 2016. The main difference under the old polling system, college graduates were overrepresented in the surveys, whereas in the new system, education is now one of the weights by which should lead to a more representative sample that is more representative of the overall voting population. That combined with more funds to these state level polls, we think that the chances of these polls being wrong this time around is less than it was 4 years ago. And actually, if Trump were to win the election this time, we think it would probably be a greater surprise than it was 4 years ago. Now, what are the indicators of implied probability been showing? Well, there are three measures that we have looked at most closely in the last few weeks leading up to the vote that give a decent indication as to what the market is pricing in. The most noteworthy, the one that we probably place the most attention to, is that from 538, which is a very reputable website that follows the election. So this has is a simulated model that models the outcome, simulates the votes on 40,000 occasions, and then aggregates all those outcomes, comes to an average probability for each candidate. So that currently gives Biden around about an 87% chance of winning, 13% President Trump. There are similar measures that we look at as well. Online prediction website Predict It, that now shows around about 65% chance of victory, which is very similar to the implied probability based on bookmaker odds. So while those measures show a slightly less of a chance of Biden winning than 538, it still gives Biden the clear edge. And these tend to be pretty good barometers, we think, as to what the market is pricing in. And actually, if you look at these measures, whether that be from 538 or Predict It, the increased probability of a Biden victory has coincided with a rally that we've seen in risk assets in the last few weeks. So as the market becomes increasingly more confident of a Biden victory, we've seen a sell-off in the safe havens, including the dollar, and a bit of strength in those higher risk assets, emerging markets, for instance. So all of this suggests that we would have to see a pretty major turnaround in the last few days for Trump to turn the tide on Biden and for him to win the election. So how does the US voting system work? Well, the President of the United States is not voted for by a popular ballot. Instead, each state is given a number of electors that cast an electoral vote, whether that be for Biden or for Trump. So whoever wins in each state will receive all of the electoral votes in that seat, regardless of whether they win by 1% or whether they win by 40 or 50%. So these number of votes are assigned based on population. So the most populous state, California, receives the most number of seats, I should say, that's 55. We have Texas, 38, I believe Florida is 29, and so on and so forth, until the smaller states that receive no fewer than 3. And actually, if we look at a state such as Alaska, for instance, which has the largest land mass of all the US states, actually receives the fewest amount of votes in the Electoral College system due to its relatively small population. So the winner needs at least half of these, so 270 is the magic number that each candidate will need in order to be elected president. There's never been a tie in presidential election history, but if there were to be, that would be decided by the House, but very, very unlikely for that to be the case. Now, an added complication in the US elections is that Americans will also be voting on the composition of Congress. Congress is the US government, which is made up of both the US House of Representatives and the Senate. So all 435 seats in the House will be contested, as will 35 out of the 100 seats in the Senate. Now, this has a pretty significant bearing on the election and on US policy. A president that has full control of Congress, full control of the government, will have an easier job in forcing through legislation through the government. If we look at the first couple of years of Trump's presidency, when the Republicans had control of both the House and the Senate, it was relatively easier for Trump to force through his policy changes than it has been in the last 2 years since the midterm elections, where the Republicans lost control of the House. So as things stand, the Democrats look very likely to retain the House, and actually we think there's a pretty good chance that they could take the Senate as well. And then Enrique will talk a little bit later about the potential repercussions this could have on policy and the FX market.
One thing to keep in mind is that the structural makeup of the U.S. government system means that as of now, the smaller, more rural states are overweighted both on the Electoral College and the Senate, which gives the Republicans a bit of an edge. It's estimated that in order to keep control of the House, the Democrats need anywhere from 3 to 5% advantage in the polls, and the Electoral College means that the Democrats have to win at the national level by anywhere from 2 to 4% in order to be certain or reasonably certain of Electoral College victory. Nevertheless, the polls this year are indicating that the Democrats are likely to overcome that advantage at the presidential level for certain, and less so at the Senate.
Yeah, and that's what we saw 4 years ago, wasn't it? It was when Clinton actually won the popular vote. To lose in the Electoral College system was only the 4th such instance that happened in history, but the second, I think, in the last 5 elections. So
yes, she won the national vote by 2 points, which was not enough to overcome the Democrats' structural disadvantage in the Electoral College.
Yeah. Okay, excellent. So we'll go on to the swing states, and there are 7 key swing states that we've identified this time around for this year's election. These are based on, first of all, how close the polls are. So there's a relatively narrow in the polls. It's likely that it could shift in either direction. And also how many seats are up for grabs. So the ones that have the most number of votes, obviously these are the ones that the investors in the market will be paying closest attention to on election night. So those 7 are Florida, Pennsylvania, Ohio, Michigan, North Carolina, Arizona, and Wisconsin. And out of these 7, as you can see there, Biden is currently polling higher in all but one of them, so 6 of the 7. Ohio is the only one that Trump is currently ahead in the poll of polls. And even then, his lead is only relatively narrow, 1.7%. And actually, if we look at the polls over the last few weeks or so, Biden's extended his advantage in quite a few of these. So look at Pennsylvania, Michigan, Wisconsin, for instance. Biden's advantage has grown, and it looks very unlikely that there's going to be, in our view, enough time for Trump to shift these states significantly in his direction. I simply don't think there's enough time left before polling day for some of these to shift to red. And of course, Trump would need to obtain the majority of these in order to retain the presidency. And we simply don't think there's enough time in order for that to be the case. Moving on, and this gives another good visual representation of how the states are expected to go on election night. So if we look at the voting map on the left, that represents how each state voted in the 2016 election. Obviously red is the Republicans, blue the Democrats. We can see a large sway of red where Donald Trump won a lot of those key swing states. We look at the map on the right-hand side, that represents where voters expect, or where each state is expected to go this time around. The lighter shaded states are the ones that are seen as the more swing states. So as you can see, a lot of those important states that Trump won in 2016 are now looking likely as though they're going to swing back to blue. So we look at states such as Florida and the Southeast. A lot of those Midwestern states, likes of Michigan, Wisconsin, are expected to shift from red to blue. Pennsylvania, for instance. So as things stand, it all appears as though a lot of these key swing states are swinging in the favour of the Democrats. And as I said, as things stand, it looks as though it's a bit of a mountain to climb in the last couple of weeks of the election for Trump to win. Last slide from me before I hand over to Enrique, and that's on the potential impact of the COVID pandemic on the election. And the virus situation, in our opinion, appears to be favouring Joe Biden. We look at a lot of the swing states have suffered particularly badly due to the pandemic. The chart on the left-hand side, that represents new daily cases of the virus per 1 million population in some of the key swing states. And that red dotted line is the sort of US overall. You can see states such as Florida, Arizona have suffered particularly badly during that sort of the peak of the pandemic in the US, which is June and July time. And more recently, Wisconsin as well in the last couple of months has suffered particularly badly due to the virus. And we think that this is likely to favour Biden in those states. And also Trump's overall handling of the pandemic has been criticised. That chart on the right-hand side, so this represents Trump's approval poll for his COVID response. So as of a few days ago, only around 40% of those surveyed now actually agree or approve of Trump's overall handling of the pandemic versus close to 60% who disapprove. And again, we think all these factors are likely to favour Joe Biden leading up to the election. And I'll now hand over to Enrique, who's going to talk a bit more about the financial market reaction.
Okay, thank you, Matthew. That was excellent. Well, I think probably the first thing to do is go over how markets reacted to go on a bit of a memory trip and recall how the markets reacted to Trump's victory in 2016. And the main thing to recall is that the immediate reaction to the surprise of Trump's win was very different from the medium and long-term reaction. Initially, the US dollar sold off, as did markets, very quickly on the night of the election, as it was clear that expectations had been overturned. But very quickly, markets reversed course as they realized that the main macroeconomic impact from they assumed that the main macroeconomic impact from the election would be, as it did eventually transpire, a large tax cut addressed mostly at corporations. This did happen. The months after Trump's election were one of a steady rally in stock market, the S&P 500, and risk assets in general. Credit rallied as well, and also the euro dollar as it became increasingly clear that one unexpected aspect of the Trump victory would be an emphasis on tariffs and perhaps even a threat to the globalization of the supply chains. Nevertheless, it's important to remember, I think, that these rallies in assets had more to do with international context and the continued easy policy from central banks, in particular the Federal Reserve and the European Central Bank, that specific policies followed or not followed by President Trump. The one thing is clear, the reaction on election night by stocks and currencies make it clear that markets hate uncertainty and prefer it when risk events such as elections happen following the expected script. Matthew, we're going to move to the next. So far in 2020, it's hard to disentangle the US election from everything else that is going on in 2020, in particular, obviously, the pandemic, the COVID pandemic, and the reaction from the different monetary and fiscal authorities to it. But if we focus on the last few weeks. I think it's fair to say that starting in mid-September, the risks over the U.S. election have been looming larger in the market, in traders' minds. The reaction to the consolidation of Biden lead and hopes that the Democratic wave means additional stimulus in the U.S., additional fiscal stimulus, have been well received by markets. The S&P 500, the main U.S. equity fund, is up 6% since late September. Now, uncertainty over the election, 1 month implied vol, by which I mean that part of, in a way, is 1 month implied vol measures the risk, the cost of taking market insurance over the U.S. election, over 1 month, has jumped once that month deadline covered the date of the election, but not dramatically. We're only up to August highs. So, and we have actually, the cost of insuring against market moves over that date has actually pulled back over the last few days. And that tells us that markets are increasingly confident that the surprise of 2016 will not be repeated, and that Biden will win the election. We do expect volatility to ramp up modestly over the next few days, as especially if polls narrow. Now, so far that's not happening in any meaningful way. The newest polls are consistent with Biden maintaining a close to double-digit lead, but not quite, somewhere around 8 to 10%. And if the market should be reacting to the polls as they come in and send the dollar weaker and stocks higher, the higher that lead goes. Conversely, if that lead narrows, we should see heightened risk aversion. Now, this is the one that is probably hardest to predict. What a contested vote would mean for currency markets. Now, it is increasingly likely that Trump will refuse to accept defeat. The big question is what he will do about it. Now, the reasons why he may use to refuse to accept defeat are that due to partly to the pandemic, mail-in ballots are expected to be a much larger part of this election, twice as many of the total ballots as in 2016 are expected to be mail-in votes. This increases the chances, modestly, that there will be no election result out of the contested days, some of the contested states on polling day, so that the TV networks, which are the traditional semi-arbiters of the election and the ones whose job is to call the election one way or the other, will not be able to do so on election day. Trump has stated in an ambiguous way that he expects the Supreme Court to be involved, but he hasn't made clear how that would happen. A contested election, it's important to bear in mind that the risk of that has also gone down over the last few weeks as Biden's lead continued to increase and consolidate, especially most of this battleground states that Matthew Ryan was listed. Nevertheless, there's a small chance that this will happen. There's a small chance that there will be uncertainty over the result. In that case, we would expect a knee-jerk reaction of flight to safe havens. The dollar continues to be one of them. The dollar, the yen, the Swiss franc would benefit from a short-term knee-jerk reaction. However, if the standoff continued over any significant length of time, we think that at some point the impact on markets will reverse, and what would be seen as a dollar negative in the long term as international concerns over U.S. institutional stability and the quality of its institutions would eventually make U.S. assets less attractive for international investors. So now the big scenarios. What would happen in each of these? Now, I think that there's some scenarios that can be ruled out, like such as Trump winning and the Democrats taking the Senate, but pretty much every other scenario with each one of the branches of the legislative and executive power is possible. To us, we think that there's not quite, but almost a 50% probability of what is called a democratic wave. The Biden wins the presidency, and the Democrats keep the House, on which where they have a reasonably large lead right now, and also manage to take the Senate. In this case, we would see clearly significant fiscal expansion on the one hand, clearly a very large stimulus package would be passed. We would see higher corporate taxes. We expect to see more or less a repeal of the package of tax cuts that was passed by Trump when the Republicans controlled both the House and the Senate back in 2017. And the emphasis will be taken away from the trade war. We think that that we would see the market celebrate the lower chances of tit-for-tat retaliation between the US and China, but also between the US and the Eurozone. In this case, the market reaction would be mostly to the fiscal stimulus, would be a very good, would be considered a very good outcome for risk assets in general. Stocks and bonds and credit would rally hard, we think, and the dollar would go lower, both as risk appetite increases and investors flock out of risk havens like the dollar, and also the prospect for much larger deficits out of the US in the future. The second most probable event is, in our view, is a Biden victory, but where the Senate's just managed to keep the Senate. In that case, it is likely that the fiscal loosening would be much more modest. There would be much less of a spending package. Also, we would see the uncertainty of a trade policy diminish, because that is the purview of the president, and Biden has shown little appetite for the kind of trade conflicts that Trump was known for launching. The taxes would probably not go up in any significant way. The 2017 package would not be repealed. And in this case, we would see like a muted reaction, like a muted version of the blue wave, with the dollar flat to lower and risk assets slightly higher. Now, the other scenario is that Trump wins and the Republicans keep the Senate. We think that there's not about a slightly under a fifth chance of this happening. This would be essentially the current status quo, the current situation. Very small package, or no additional stimulus. Definitely no repeal of the 2017 tax cut, and we would continue to have a similar levels of trade uncertainty as we do now. This would probably mean that the dollar and risk assets would, after some initial volatility, end up where we are right now, without much change. And finally, there's a small chance, very small, because like I said, the Republicans, the chances of the Republicans taking the House are very, very slim, given the current Democratic lead there. And then if there was a red wave, we would have modest fiscal expansion targeted at higher incomes and corporations. And we would probably see, given the shock that this result would be, higher dollar, and at least initially, stocks and credit would go down modestly. But again, the chance of this happening is very slow. We peg it at no more than 2%. Now, we will now talk about how the prospects of the three major currencies, the euro, sterling, and also yuan, who's becoming increasingly a currency of focus for our clients. The euro has rallied on the months after the vote, and this has happened as markets increasingly priced in the possibility of a Biden victory, and in addition, the possibility of a blue wave where the Democrats take the Senate. This is the markets having a celebratory move to the possibility of, like we said, of additional stimulus out of the US, the end to trade uncertainty. And surprisingly enough, markets have taken a very sanguine view of the rising virus cases in Europe, where, as we saw earlier, the gap between COVID cases in Europe and the US that we were seeing a couple months ago has largely disappeared. As to the long-term prospects, given our expectations for the US election, our bet that Biden will win and that there's a significant chance of a blue wave, we remain bullish on the currency in the long term, but think that short-term losses are possible. First of all, we have yet to see the impact of this new second wave of COVID in the European economic numbers. We expect to see that to filter through the economic releases that will be coming out over the next few weeks. We expect eventually this second wave slowdown to bring the European Central Bank to announce additional stimulus measures, which should be a negative for the euro in the long run, in the short run, and also in the short run, the positioning in the euro currency, that is the extent to which short-term traders have placed bets that the euro will continue to rise, as we see in the next slide, is near record highs. This is a bit counterintuitive, but when the speculators' positions are that a currency will go up or down at record levels, the opposite tends to happen in the short term because essentially there's no one left to place that bet, and any significant pullback on the euro will probably bring position closing and stop losses from speculative traders. So the positioning backdrop is not positive for the euro, and so we think that it will take a few weeks while these positions are at least a few weeks before these positions are worked out and absorbed before the euro can resume its long-term trend. Sterling is harder to predict because, in addition to the risk factor of the US election, is driven even more by the headlines around the Brexit negotiations on a deal. Now, it is true that the talks have stalled late last week, but it's also true that Boris Johnson promised to stick to October 15 deadline has not been kept, and negotiations are in fact ongoing. Chief negotiator Barnier on the US side said that deal is within reach, and both sides are hopeful that by mid-November we will have a skinny deal, what is called a skinny deal. It will not be as comprehensive a deal as most people were expecting perhaps 6 months ago, but it will be sufficient to remove the possibility of a no-deal scenario, which is the chances of which have always been waiting on sterling ever since the negotiations started after the referendum in 2016. So our view that we will reach some sort of last-minute bare bones deal that allows both the UK and the European Union to walk away from the cliff edge of a no-deal Brexit, and perhaps continue negotiating specific aspects of the post-exit relationship in 2021 and beyond is very like this view is very likely to be supported by events, and we think that the recent rally in sterling is justified, and it may even have some room to continue. Now, how could the election impact the yuan? We think that the Biden victory that we predict will be a significant positive for the yuan. The tariffs passed by the Trump administration on Chinese trade are not quite crippling, but are definitely damaging at the margin to Chinese economic prospects. With Biden win, we expect to see a move towards multilateralism and less protectionism, given that we peg the chances of a Biden win at 80%, in line with most polls and betting markets. We think that the yuan is likely to come out of the election strengthened. But beyond the short-term impact of the election on yuan, I think that it's very important to reflect, as we'll see in the next slide, that one of the structural changes that we've seen with the COVID crisis is that the way we describe it is that the club of hard currencies is a new member. I think it is wrong to continue describing the yuan as an emerging market currency. I think its performance during the crisis has been very different from that of an emerging market currency. As we can see here, it has basically performed very much in line with the US dollar. It has acted as a refuge in times of crisis. It's clear that investors internationally increasingly regard the yuan as a store of value. And what is very important to see in figure 18 is that this excellent performance during the crisis of the yuan has not come at the expense of Chinese currency reserves. Right? So not only, in fact, Chinese reserves have increased even as the yuan went up during the crisis, which means that investors actually bought the yuan. The Chinese authorities did not have to spend any of their reserves in supporting the yuan. In fact, investors themselves made the decision to buy yuan as a protection against uncertainty. It is something that happens very rarely, where countries go from an emerging market status to a store of value status. I think the last time something happened with a major currency, frankly, was the US dollar during World War I. So I think this is the first significant change in the status of an economy, of a major economy, since probably in the last 100 years. And I think the repercussions of this massive change have yet to be understood fully by markets. So the key takeaways is that Biden advantage in the polls is clear and appears to be more solid, and the polls appear to be significantly more reliable than they were in 2016, because both pollsters have learned their lessons from the election, and the Biden lead both at the national level and in the battleground states that count is much larger than it was in 2016. We expect the Biden victory, with or without the Senate, to be good for risk assets and bad for risk havens like the US dollar, with a Trump victory being the reverse. And the main downside scenario here is clearly a seriously contested vote, which again, because of the size of Biden's lead, looks less likely, but is still the main risk to the outlook. And if it were to happen, and I want to emphasize that the decision to turn this into a contested election is not Trump's alone to make. Whatever Trump says, we think that if Biden's lead in the key states is sufficient, the Republican Party is unlikely to go along with a full-on constitutional crisis. But still, this is the main downside risk to the event, and that would clearly be in the short term positive, both counterintuitively to the dollar and to safe haven assets in general.